I think that gold will do well anyway. And given the fact that gold has rewarded me very well, albeit punished me too, but very well for 2 or 3 years at a time over many decades. In my experience, Antonio, and past doesn't have to be prologue, by the way. In my experience in precious metals, gold establishes the market. Gold is first. Silver moves further and faster. And silver is, in fact, more hated than gold. So I'll be looking forward to making silver allocations precisely because it's disappointed so many of the faithful, precisely because it's so deeply out of favor, precisely because it has no momentum, precisely because there's all hate.
Market conditions align favorably for the gold market as the precious metal benefits from safe haven demand and growing expectations that the Federal Reserve will cut rates sooner than expected. The gold market is concluding the week, testing resistance at $2,050 an ounce, and according to some analysts, the precious metal still has room to move higher as bullish momentum is just starting to pick up. February gold futures are looking to end the week at $2,047 an ounce, nearly unchanged from last Friday's close. Although the yellow metal cannot close the week with a gain, some analysts note that investors shouldn't be too disappointed as prices are well off their 4-week lows seen at the start of the week. Gold is seeing renewed interest from safe haven demand as investors look for some portfolio insurance ahead of the weekend due to growing turmoil in the Middle East. Rick Rule, the founder of Rule Investment Media, highlights the intriguing disparity between the performance of gold as a commodity and the prices of underlying gold equities. Despite occasional challenges, he highlights that gold has consistently rewarded him well for 2 or 3 years over many decades. Data released on Thursday showed consumer prices in the United States increased more than expected in December. This and hawkish remarks from Fed officials fueled speculation that interest rates could stay higher for longer. However, the markets are pricing in a greater chance of a rate cut in March, which continues to undermine the US dollar, USD, and supports the non-yielding gold price. Regarding the gold equities market, Rick reveals his attraction to it in both the beta sense, investing in what he perceives as the highest quality companies that might outperform the general market, and in a more risk-on posture by delving into private placements, particularly in earlier stage companies. He finds the gold equity space appealing precisely because it hasn't performed as expected. Now, we present the clips of Rick Rule's insights from his recent interview with Resource Talks. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I'm interested in the disparity between the performance of the gold price itself as a commodity and the prices of the underlying gold equities. Given that I think that gold will do well anyway, and given the fact that gold has rewarded me very well, albeit punished me too, but very well for 2 or 3 years at a time over many decades, I'm attracted in the context of the question that you asked me about a range of gold equities. I'm attracted to the gold equities market both in the beta sense, which is to say buying what I consider to be the highest quality companies, because I think that those companies probably will outperform the general market, at least those portions of the general market that I'm comfortable with. But I'm also accepting a very risk-on posture by trying to invest primarily in private placements in earlier stage companies where either they have an absolutely superb area play concept, very much like the success that Kennerland enjoyed a couple of years ago, or where they have what I consider to be a really good discovery drill hole and some follow-up holes where the market hasn't paid particular attention. So I'm really attracted to the gold equity space precisely because it hasn't performed. One of the things I'm certain when I talk about gold, and more when I talk about silver, is that there will be comments in the sections underneath this video that say, why on earth would he be advocating gold? It hasn't performed. That's precisely why I'm advocating it. I remember very much the comments that accompanied our discussions about uranium 2.5 years ago. Uranium is dead. Why would I buy uranium? Well, certainly the last 18 months has answered that question. And I suspect that 2024 or 2025 will answer the question around the gold equities too. And I suspect that the answer will be very much the same. So I'm attracted to that.
It's a
And as I
challenge.
say, both as a beta investor, which is to say in the high quality names, and as an alpha investor in the very, very, very high quality but more speculative names. A circumstance where the hyper juniors have underperformed the broad market so spectacularly and where the liquidity is gone that I'm seeing companies that used to have $150 million market caps that have very good exploration targets and proof of concept by way of discovery holes with market caps at $6 or $7 million Canadian, doing save the company financings right now with full long-term warrants. And that circumstance where you combine uh, an improbable outcome, which discourages people, with a lack of liquidity, which discourages people. But around a play that, with admittedly improbable success, yields a 10 bagger or a 15 bagger or a 20 bagger with a full warrant. And note that with a full warrant, a 10 bagger becomes a 15 or 16 bagger. I can't help myself. I'm going to do that this year because the stuff is so out of favor compared to 2019 and 2020 that I believe that an intelligently constructed portfolio of 12 to 15 of these things probably generates combined internal rates of return north of 50%, which I'm looking forward to.
Leveraging extensive experience in the precious metals market, Rick underscores the notion that past experiences serve as lessons rather than infallible predictors of the future. Traditionally, gold establishes market trends, with silver following suit, often displaying more pronounced and rapid movements. The recent rally in the price of silver to approximately $23.35 is attributed to a December Producer Price Index, PPI, report from the United States Bureau of Labor Statistics, BLS. Contrary to investor expectations of a 0.1% rise in headline PPI and a 0.2% increase in core PPI, the headline PPI contracts by 0.1% and core PPI remains stagnant for the second consecutive month. Against this backdrop, Rick anticipates making silver allocations, citing silver's status as more disliked than gold. He identifies potential in silver precisely due to its track record of disappointing investors, being profoundly out of favor, lacking momentum, and encountering less competition in the market. Let's return to the interview.
In my experience, Antonio, and past doesn't have to be prologue, by the way, in my experience in precious metals, gold establishes the market. Gold is first. Silver moves further and faster. And silver is, in fact, more hated than gold. So I'll be looking forward to making silver allocations precisely because it's disappointed so many of the faithful, precisely because it's so deeply out of favor, precisely because it has no momentum, precisely because there's all hate. Uh, there's less competition in that market. People want to be contrarian when it's popular, and that's a hell of a chore, you know. So I like the gold and silver market, but the truth is that I like any company that has a deposit that could be, from my point of view, tier one. I define tier one as in excess of $10 billion in situ recoverable reserves and resources that could be in the best quartile worldwide in terms of return on capital employed, certainly 25% plus, and also in the best cost quartile in terms of AISC worldwide. So names like Sovereign Resources, which is a rutile and graphite and rare earths play, in Malawi, a country that most people can't spell or pronounce, attracts me. Centaurus is another example. Platinum and palladium and nickel play, all out of favor. In Brazil, it attracts me. I'm, in a sense, less commodity centric when I see a deposit that has the chance to be a critically important deposit that has to be bought by a major. You'll note from that answer, and we've discussed in past interviews, the fact that I'm much more accepting of political risk or perceived political risk than many of the people that you have on your show. I've been treated poorly in almost every country on the planet, and I don't expect to be treated particularly well in countries that other people believe to be riskless. So I go where the deposits are. You'll note from earlier discussions as an example that I've been a 40-year beneficiary of the efforts of the Lundin family. And they've taken me to Mongolia and Papua New Guinea and Sudan and Syria and Ethiopia. Many, many, many countries that speculators either couldn't spell or wouldn't invest in, but with great results. And so I'm very willing personally to take what's perceived to be political risk in exchange for really, really lowering my technical risk. I realize that's not a popular thesis with people, which is probably one of the reasons why it's worked for me.
The short-term technical outlook for gold price remains in favor of buyers after the bright metal closed Friday above the 21-day simple moving average at $2,046, breaking the weekly range trade to the upside. How do prevailing market factors impact the gold market's current and potential future price movements? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.